Hello, and welcome to the Go No Go show here on August 24th, 2023. My name is Tyler Wood. I am a CMT charter holder, and today let's see if we can all figure out these markets together. Alex Cole is with his family in the United Kingdom, so you're stuck with me once more. But let's dive right in to our cross-asset heat map just so we can get a sense of the asset classes at the highest level from a trend perspective. So in this heat map, we're looking at absolute trends. This top panel is the S&P 500. We see that in no-go trend conditions. So if you're new to no-go charts, we've got pink and purple bars representing those downward trends and letting us know the strength and direction of securities trending. So pink is our weaker form of that trend following model. If we look to the second panel, TLT representing sovereign bonds here in the US, also in a weak no-go trend. And remember, bond prices are going to move inverse to yields. We're going to talk a little bit about the Jackson Hole and expectations for where rates are headed here in the United States. That meeting starting up tomorrow morning. In the third panel, we've got the U.S. Commodities Index in a strong go trend. So the aqua and blue bars represent the upward direction, uptrends in our trend following model, weak and then strong form. So the blue is the strong form for the U.S. Commodities Index trending higher. Fourth panel, we've got the US dollar index. We're using ETFs as proxies for a number of these asset classes. UUP is the ticker symbol. That is also in a strong go trend, strengthening US dollar. A lot of commentary from analysts about the TINA factor. There is no alternative. So on an ugly block, US debt and currencies seem to be the most attractive alternative as Europe is facing recession and the rest of the world is also heading lower. In the final panel, we've got a Bitcoin chart, BTC USD, obviously in a strong no-go trend. And that's on an absolute basis. So we're just looking at the price action of these top-level asset classes just to give us a sense of what's happening around the board. This top panel up here, of course, the price action for the S&P 500, again, in that weak go trend, the SPY ETF. So speaking of the S&P 500, let's take a look at the price action. We spoke a little bit last week about pullbacks within a longer term or structural uptrend. As we saw in March 23, those moves can be swift, but fairly short-lived within a broader structural uptrend. That's what we've seen so far in this pullback, finding support at pretty key levels. We reached an oversold condition on the GoNoGo oscillator. All of this taking place on heavy volume. But we've come back up to retest the zero line. Here I'm recording this midday on Thursday. We've had a heavy day in the markets. We see a trend continuation icon within that no-go structure. So when we're in no-go trends and we've got negative momentum, you come back up to test that zero line. That's our important leading indicator of what we can expect in future price action. Being rejected at the zero line, not a great sign for the upward mobility and constructive evidence for this bullish trend in the S&P 500. So we're on a weak form no-go. We do have momentum moving back to the downside, but volume has lightened up. So maybe a little less commitment or enthusiasm from market participants with this downward move here today. It's going to be important for us to look at the close of the week, which we'll find out tomorrow where we're at. Perhaps a little anticipation of tomorrow's commentary from Chairman Jerome Powell at the the Jackson Hole meeting. Wow, I'm all over the place today, folks. It's the end of summer. This is the look at the S&P 500 on a weekly basis. So when we talk about that structural move, looking at longer term charts can help us gain some perspective on what these pullbacks mean. So on a weekly basis, still in a go trend, the weaker form, aqua bars painting up here in our price panel. What my eye is drawn to is the GoNoGo oscillator. Testing the zero line from above. We're just beginning the early innings of a go-no-go squeeze. We've been resting at the zero line now for a couple of weeks. A little bit of indecision on that weekly time frame for momentum. Clearly, if we find support at the zero line within this go trend, we're going to see a trend continuation icon. And then all bets are off, pointing to the upside in terms of the path of least resistance. We did find ourselves hitting resistance off those early 2022 highs prior to the bear market. If we can retest those ultimate highs and break into new territory, all-time highs for the S&P 500 is very important for those in the bullish camp. That means we don't have any areas of overhead resistance. There's no overhead supply that can get in the way of that go trend. So stay tuned for that. We'll see how the rest of the year pans out. But this weekly bar still in play here on Thursday midday for the S&P 500. So as we talked about that cross asset map, a lot of conversation around credit markets, sovereign debt, and yields here in the U.S. Let's take a look at the TNX. That's the 10-year Treasury yield. We're looking at this on a daily basis, and we've heard the narrative higher for longer. Very important break on a quarterly. Yes, I said quarterly chart of the TNX as we broke that 40-year downtrend line last year. We've surged higher in 2022. Obviously, that created a lot of headwinds for U.S. equities and other risk assets. And here we are right now. We came up to those highs from October of last year, and we were rejected. So what we've got on the chart right now is just this trend channel. So we found resistance at this lower bound of the trend channel, multiple touch points being rejected lower. That break above, a little fake out first, but quickly resurging to retest and break through that lower bound of the trend channel. Now we're seeing that the upper bound is forming that as an overhead resistance, a supply shelf, if you will, sending price action back down on this 10-year yield. It would not be surprising, as we know, markets can move in three directions, right? Up, down, or sideways. And so this trend channel, this activity here, higher for longer might mean that we're chopping around with rates in this region for the next several weeks. So that's the daily view on the TNX. Another way to look at interest rates is to look at the bond market, right? We talked about how these move inverse to each other. The bond buying, this is 20-year Treasury bonds for the U.S. market, finding support here at this key level right down here just a few days ago, and really rallying strongly. As a lot of analysts have mentioned, even on StockCharts TV, that it would not be surprising for rates to break higher up towards 5%. But we could be consolidating in this trend channel for some time before meeting those new highs. The buying in the bond market, obviously, working in inverse to yields, and we are seeing that some anticipation from credit investors looking at potential resistance areas and an opportunity for bonds to find some support and take off. From a trend following perspective, here at GoNoGo Charts, we're less interested in the narrative or in anticipating what Chairman Powell might say or what we think might be around the corner, and instead just reacting to what the market is giving us. The market tends to know all, certainly before we can as investors. So finding support here at this little support line, and then retesting the zero line, the GoNoGo oscillator. Light volume, but surging back up to zero on these strong moves upward for TLT, the 20-year Treasury ETF. We'd like to see that break through the zero line as a leading indicator that perhaps there could even be a trend reversal in bond buying. So that's what we're looking for here at the zero line. If we're rejected lower, then obviously bond prices moving lower and yields continuing to move higher, likely to be stuck within that range of consolidation for some time. Moving on to another macro factor at play, we talked about the strength in the U.S. dollar, strong blue go bars for the last couple of weeks, and a lot of speculation about how long this trend can last. Yesterday was a very heavy day for the U.S. dollar. Folks looking to sterling, Great British pounds as alternatives in the currency markets. What we're seeing on this chart right now is, again, that same idea of polarity, right? What was resistance, once broken through, can become support. So we had multiple touch points of this line in March, and again in June, and again in July, where we finally broke through here in August. That's certainly pointing to upside potential for the U.S. dollar, strengthening currency. But just look back at where we were this time last fall, a very messy, choppy area within this trend channel. And the top bound, the upward bound of this trend channel, obviously putting out a very strong resistance, support area for the US dollar through the fall of last year before we broke through it. Some big gaps down into 2023, we saw weakness in the US dollar and this range bound activity. So we're back in the channel. Can't promise much more than choppy price action. We do look at the GoNoGo oscillator for some leading indications from our momentum studies to tell us that we reached an overbought extreme, pulled back from that. That's the counter trend correction arrow that you see above price. Volume has picked up as well. So again, we're using UUP. It's an ETF proxy for the dollar index. So we can get a sense of volume as well. Heavy volume. We pulled back from that overbought territory and immediately surged back to a positive 5. So not extreme readings, but certainly strong momentum on heavy volume with a strong go trend. There's certainly a lot to say about the strength in the US dollar right here. I would certainly like to see us move up to this top end of the price channel before making any further estimations about where that trend could take us beyond. So that's the story here in the US dollar. Let's take a look at some of the commodities like US oil. Here on the daily basis, again, that concept of polarity that we talk about all the time at GoNoGo Charts, what was resistance broke through, should be support for us. But it's not in the case of US oil. We did not find support at this 72.50 level. Instead, we've broken down below. Some strength over the last couple of days. But what's really telling is this go-no-go squeeze. As we talk about volatility compression in some of those educational videos that Alex and I recorded for you all, volatility squeezes are really important for us to pay attention to in both a trend continuation and a trend reversal context. So right here, what we were looking for in terms of a trend continuation, right? We were in a go trend for US oil on this daily chart. We were in positive territory for the momentum studies here in the GoNoGo oscillator. Picked up heavy volume as we came to the ultimate high, but the volume picked up to the downside, and we started to test this support level as we formed a go-no-go squeeze. That's the decision point. That's the tug of war between buyers and sellers. Volume picking up as prices moving lower. We get to that resistance line. It doesn't hold, and the go-no-go squeeze is broken, not back to the upside in a trend continuation style, but below zero. Now we have negative momentum in this go trend for US oil. Certainly very damning evidence for further upside potential in US oil. For a little better perspective, when in doubt, we zoom out. That's the weekly chart. And we've been talking all year long, like a broken record, about that choppy range bound drifting lower in US oil. Certainly the energy sector picked up very, very well over the last couple of months. We saw oil surging. That's what formed this new go trend. But here where we tried to get above this resistance line, we don't seem to be holding. This week's bar is still in play. We'll see how the week ends up. But right now we're below that support level. And we do see on the weekly basis, the go-no-go oscillator staying in positive territory, right? This was the big trend reversal where we broke out of that go-no-go squeeze to the upside. So we're getting a little mixed signal between the weekly and the daily. But what I'm looking at right here is the weekly bar closing below that support line. What was resistance becomes support. And if it doesn't, we know that from failed moves come fast moves. So paying attention to US oil trading below that what should have been a support line, should this trend have held, and then seeing on the daily basis some negative momentum or selling enthusiasm. So that's a little look at the oil sector. Let's take a look at precious metals. Last couple of days have been very strong for gold, and really interesting on this chart. We see that we've got a very important key support level at the bottom end of this gap, and we can also see that within this no-go trend, we've had heavy volume, we've had very strong negative momentum, and we're back here testing the zero line. We found support at this level right here, 175.50, and gold is in the weaker form now for the no-go trend. What we envision, if this momentum oscillator moves above the zero line, then we might see a threat to this no-go trend, potentially a trend reversal in gold. That's the daily chart. Let's take a look at the weekly just for a little broader perspective. A lot of fans of the gold out there as we were reaching these ultimate highs. looking for perhaps an all-time high breakout in gold. Never materialized, frustrating a lot of investors in the gold space. But we have found support here at this support line right here at 175.50. We're in the weaker form of the go trend condition. So that trend model in the background telling us the weight of the evidence is still to the upside. But we are seeing the threat to that go trend in the momentum oscillator. The GoNoGo oscillator is at a -3. We've got light volume on this GLD ETF for gold, but we are still above that support line. So interesting view on gold, and we'll see what happens as we reach the close of the week, and be with you here every week on StockCharts TV on Thursday afternoons. So that's a little look at the macro picture. Let's take a look at the US market from a style perspective. So we look at the Morningstar 9 style boxes. When we talk to a lot of our private wealth managers and clients who are investment advisors, that they're very concerned about style allocation, about sector allocation, trying to move some money around tactically and get the style and sector bets correct first. So looking at this heat map, it's a pretty clear picture. The only style outperforming the S&P 500, and yes, we are in a no-go trend. So these relative ratios are telling us what is outperforming. Could still be in an absolute no-go trend, but outperforming the S&P, and that's large cap value. So certainly over the last few days and the last 2 weeks, we have seen the US market rolling over in this corrective phase. We've seen all of the growth categories underperforming the S&P 500 index, except for large cap value. So that's a little look at the style boxes. Let's also get under the hood and take a look at the sectors of the S&P. Now, we do this every single week, but just to talk about it one more time, we've got each of the ETF sectors of the S&P relative to the benchmark index. And why is that important? Well, we care about relative strength to find where the fish are, right? If we're going to be looking for individual securities or industry groups that are leading the benchmark index, we have to start with this relative strength concept and look at those sectors on the ratio chart, if you will, to tell us what is outperforming or underperforming the S&P. Now, last week when I was with you, we had strong outperformance from all of our cyclical sectors. This week, that rotation has changed. We're neutral in the financials and the industrial sector. Materials have rolled over to a strong no-go trend. Certainly, those who are hoping for a dovish Chairman Powell, the inflation narrative, we want to see materials prices headed lower. But healthcare has held up. And we talked a lot about the pharmaceutical space last week. The note that went out to our institutional subscribers on Monday morning highlighted a few other pharmaceuticals companies to take a look at within that relative outperformance of the sector to the index. And that's what we're going to do again today. But I want to pick on a couple different sectors. We want to take a look at the communications sector specifically. Out of all of our growth equities, and remember we just talked about stylistically value outperforming growth, but in our information technology sector, we've seen a weak form of the no-go trend this week. So lightening up a little bit from that relative underperformance that was so strong last week. We've also seen consumer discretionary continue to be in that strong no-go trend condition over the last few days. But communications outperforming the S&P in strong go trend conditions. So the weight of the evidence for the communications sector is that we're outperforming the S&P, strengthening to the upside. So if we take a look just to review on the XLV, when we talk about the ratio charts, this is healthcare to the S&P 500, just to simply dividing the sector over the index, and we can see that outperformance. Interestingly, in healthcare, we're holding on to these weak form go trends, right? Still outperforming the S&P, but we've got a decision point here on the GoNoGo oscillator. We're at zero. We're building a GoNoGo squeeze. And so we're looking to see if this will hold as a support level, what was resistance at the turning point, the trend reversal back here in July. We'll see if that holds as support, and we'll see if the zero line holds as support for the GoNoGo oscillator. That would give some strength and credence to the outperformance in the healthcare sector. For the communications sector, looking at the same ratio chart, This is a weekly view of the XLC versus the SPY. So communications over the S&P 500. And sure enough, for many weeks, we have been drifting higher in the communications sector. That's through both the uptrend in the S&P as well as through this recent pullback. We've actually strengthened in the communications sector to a strong blue go trend condition on this relative ratio chart. So that's a really constructive sign. We're also facing a decision point here on the weekly basis for the communications sector because we're back at zero. And as you've learned in all of those educational videos that Alex and I recorded, when we're in a go trend and we see positive momentum, it's just like Ralph Acapora told me. Momentum can surge, and then that baseball, if you're playing a game of catch, can come back down to your glove. As long as you catch the ball, momentum can continue again. So momentum oscillators can range to overbought and back to neutral within a go trend. And that's what we're visualizing here on the GoNoGo oscillator. We've got go conditions, and we're looking for support at 0 for the XLC. Now, if we wanted to just take a look under the hood of the communication sector of the S&P 500, we could take a look at this industry group rel map. So these are the industry groups within communication sector relative to that sector that's outperforming the benchmark. And here in the top panel, DJUSNS is the ticker symbol for the index of the internet stocks within the communication sector. And there's some pretty interesting names in here. I know all of you want to talk about NVIDIA and what an important earnings call there was last night, but we don't use the F word here on the GoNoGo show. We want to look at trends, not necessarily what the company earnings potentials are. That's all going to come out in the wash with price action. So within that internet index of the communication sector, some really interesting names popping out. Here's Activision, Blizzard. This is a weekly view. So again, these are longer term charts just to get an idea of where trends could continue. We've got this channel. We're right at the bottom end of that channel, looking for support. We've got strong momentum. We were at an overbought level. We're still holding a +4, so positive momentum in a strong blue go trend condition. I would expect some resistance here at the top end of this channel, but certainly the weight of the evidence is to the upside for Activision Blizzard. If we want to jump down to the daily chart of the same ATVI ticker, you can see that we have been chopping around for the last several weeks right here at this support level. We did find support while we had negative momentum on ATVI. We're back at the 0 line. And so for this go trend to really take off again and get back into further price gains within that channel, we'd like to see this GoNoGo oscillator break into positive territory. And that's what we'll be looking for here at the close of the week for Activision Blizzard. Another name that I wanted to point out to you all within that internet industry group is a company called Match Group Incorporated. Yes, folks are still trying to find their true love, and they use the internet to do that these days. I know nothing about that. I've been happily married to my best friend coming up on 15 years. So with the Match Group, they own a conglomerate of lots of internet dating sites, Hinge and OkCupid, and a whole bunch that I've never even heard of, and probably my kid sister doesn't even use. But that's the weekly view of Match Group, where we're seeing the retest of the 0 line. We broke into positive territory here for the momentum oscillator. The GoNoGo oscillator reached an overbought extreme of 5. We see the counter trend correction arrow, but we are holding support here in a neutral trend on the weekly basis. This last bar is amber. And so if we jump down into the daily price action, we're going to see a little different story where we bottomed. We had trend reversal, the leading indicator coming out of this break of the GoNoGo squeeze to the upside. And now in this go trend, we found support at 0, trend continuation. That would be the scenario we're looking for. The GoNoGo max squeeze broke to the upside. We saw further price gains back into a GoNoGo squeeze and a quick dabble into negative momentum territory. Certainly a big threat to any go trend breaking out of a GoNoGo squeeze, but very short-lived and right back into that max GoNoGo squeeze. So what what I'm visualizing here is that there is an extreme tug of war between buyers and sellers for Match Group. And when we do get resolution of this next max go no go squeeze, we'd expect high velocity moves in the direction of the break. So all else being equal, we are in a go trend, weak form. Price range has really tightened and narrowed. If we see a break to the upside, that's very strong evidence in support of this go trend for Match Group. Now, we did also see within the publishing division industry group, of the communication sector, a number of outperforming companies. This is News Corp of America. Not sure if any of you have noticed, but there's a presidential election coming up next year, and we have to endure about 15 months of constant streaming news and commentary and op-eds. Apparently, Americans love this in just the most masochistic way. But these news companies stand to earn a lot out of advertising and extra attention and eyeballs on all of their reporting. So News Corp of America, a go trend now in its weak form, testing the zero line. We had strong, heavy volume as we were reaching that most recent high. We're coming back, consolidating, looking to find support at zero here on News Corp. Can't talk about news without the New York Times, and indeed also in a go trend, building a max squeeze here at zero, right at this 42.50 level. We'll look to find support at zero for this go trend to continue for the New York Times. I know we are out of time, but just because I'm a glutton for punishment, there's your chart of NVIDIA on a daily basis. Yes, it's been an incredible move over the last year, and certainly year to date. Another strong earnings report last night, giving a lot of credence to the fans of NVIDIA and those who've been holding it in their portfolio. This miracle company continues to perform. We've found support at zero. We're on heavy volume in positive territory. Weak go bars, a little pullback today. But I did want to also point out that within the semiconductor ETF, we're not seeing the same conditions. NVIDIA is an outlier of the broader industry group. Heaviness on this daily bar for the semiconductor ETF SOXX. We'll see if that can break through the zero line to see if a rising tide lifts all ships, and if the rest of the semiconductors complex might be able to catch up with NVIDIA. So, as you heard here on GoNoGo Charts, if you're looking for love, Match Group Incorporated, MTCH, is the ticker symbol. Give each other some love. Take care of one another. And we'll see you right back here on the GoNoGo show next week. I do believe my good pal Alex Cole will be back with us. And last but not least, I encourage all of you to join us in Las Vegas, Nevada. Yes, Vegas is back and open for business. We will be hosting a conference with two great partners, the Market Mind Summit with the Trade It Forward Foundation, starting September 21st and 22nd. And my good friend Dave Keller and I will be there speaking Saturday and Sunday at the Wynn Las Vegas, September 23rd and 24th. More details at cmtassociation.org, and we'll put the links below in this episode. Hope to see you there. Take care.